The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, folks. I hope everybody can hear me. I don't know whether this is going to work. I guess it's working. I'm just going to keep talking. Good. We're okay. All right. We're going to start the show with the announcement that tomorrow we're going to have Rich Anderson on for the commodity department, and I will be talking about the major crop report that we have coming up on January 11th. That's when we have the new moon. It's really a big report because there's so many variances between what really happened in corn. I mean, it's just tremendous amount. And this report is over the last 7 years has caused more activity than any of the other crop reports. So we'll be talking about that. The positions that we've had in the corn and the beans over these last few days have worked quite nicely. They've made their first profit objective, but you really should not go into that report flat, either long or short. If you've made money and you like being long, you could take that money and buy a call. That way you would be protected somewhat because it can really get volatile. But we'll talk more about that on tomorrow's Commodity Show with Rich Anderson from Anderson Capital Management. Someone asked me a question about Commodity Corporation and Amos Hofstadter. Many of you maybe have never heard of Amos. He died in 1977 at the age of 75. He was killed in a tragic auto accident in Florida. But he was one of the original founders of Commodity Corporation. Commodity Corporation was founded by Helmut Wilmar and Paul Samuelson. Paul Samuelson was a Nobel Prize economist, and they started Commodity Corp, I believe, in 1963. Amos was the broker for Hayden Stone, and he had traded their accounts while he was at Hayden Stone. And then Amos continued to work for Hayden Stone for quite a few years. The reason why I'm bringing all this up is that my very dear friend, one of my very best friends, Jay Cross, who was one of the market wizards, he and I wrote a book together in 1995. I contacted the Hofstadter daughter, Janet Wilson, and spent quite a bit of time visiting with her and got some photos and some things that Amos had left. And I wrote a book. It's about 100 pages. I've never published it, and I lost it. And believe it or not, I found that book on my desk 2 days ago. I just cannot believe it. I almost called the nursing home before I opened the book because I've been looking for this book for so long, and it was under a picture of my daughter's. And but anyway, it's really a good book, and I'm going to put it on a PDF file and make it available eventually, but I'm not sure when. But Amos was by far one of the greatest traders ever, and he was also a teacher of traders. I mean, he taught Bruce Covener, Mike Marcus, when these guys were just kids, and it was really amazing, the legacy that he left. Amos was the first person to use displaced moving averages, and basically he, when he first went to do the work with the Commodity Corporation, he made them get into computers, and this was in 1965, and I think a desktop computer in 1965 was probably around $50,000 if they had them, and everything was almost custom built, but they started working with those, and they worked on the program for automated trading that became so surreptitious. Everybody was very strong about the secrecy that went on at Commodity Corporation there on Mount Lucas Road in Princeton, but they did do a great job. And then eventually Goldman Sachs bought it, I believe, in 1997 or 1999. Goldman Sachs bought Commodity Corporation and absorbed it. The structure and people still work there on Mount Lucas Road in Princeton, but it's a Goldman Sachs operation now. But anyway, that's just some of the history that goes behind it. I wanted. We have a call already. This is what we like to hear. David, are you there?
I am here, Larry. How are you doing today,
I'm
sir?
good. What can I do for you, my friend?
I was wondering if I could get you to put natural gas up on an intraday chart, let's say like on a 30-minute or an hourly.
Do you want to see the natural gas futures?
Yes, sir.
Okay, then I can do that. That should be no problem. It starts with an N, so I just have to go to N. You want it on an hourly? Is that okay?
Hourly, 30 minutes.
All right, let's do 30 minutes. We might be able to see something pretty nice. We're having a big sell-off today, I see.
Yes, we are. We're having a huge
let's take a look
down.
at this. Let me update my chart because I don't do anything in this stuff very often, so it'll just take a second, and then we...
Sure. Well, we're waiting on the update. How's your friend Dr. Miller doing, by the way?
She's good. She's going to be 90 in May, and she's trading actively as always. And I'll have her back on the show one of these days. But she's certainly been a big influence in my life. Okay, I've got it here, and we're trading below the 786 that came in at 311. Is that what you're referring to?
Yes, sir. Yes, sir. Because this is, Larry, I tell you, I haven't been trading but a mere fraction compared to how long you've been doing trading. And I'm just looking at this here, and I think, keyword here, think, that we have set up potentially intraday-wise, a buy Gartley with the X point being like January 1 at 7:30 is your X point.
Yes.
And then your A point is any of the bars of January 7th to the 9 a.m. to 9:30, 10 a.m. time frame.
That is correct.
And then a B point around like January 8th, around 10:30 in the morning time frame. And then it bumps up at around noon, and then completes a 1-to-1 A to B equals C to D down on the 786 retracement. So pretty standard in terms of a pattern formation by Gartley, but the reason for my call is we had normally when I use an X point, there's some volume behind the move, and it isn't a crazy wide price spread bar on vapor-like volume at 7:30 in the evening. I guess that's New Zealand trading.
Yes. Yeah.
And I'm just like, well, I don't know what to think.
What I do is, because that was so crazy and it happened, right on Christmas, right on the day of, the 2nd of January. I really, I want to disregard it, but I can't. But what I do, David, is I go to a little bit longer time frame to see if we're actually looking, at something that's giving us the same type of number, but from a different level. And so what I'm going to do is I'm going to put in to Tiger TV. You'll take a look at this if you get a chance, but it's the daily of the natural gas futures, and that's also telling you that this 3111 area is the 61% retracement coming off of the August low, and there's a big cycle there, an 89-day cycle and a 190-day cycle that literally lines up right where it is now. So you certainly want to be looking to be a buyer of the natural gas in this area.
Okay. That's. I was looking on the daily also. I'm watching Tiger TV as we're talking here, and that's a lot. It's a great looking chart you got going. All right, so that's kind of in grand scheme of things, that kind of a wide ranging bar going back to the intraday for a brief second. And so typically you're telling me whenever you see something where, we see a crazy spike up or down and it's in the middle of, no man's land with almost no volume behind the move, you just generally tend to ignore it or wait for it to test? What typically do you...
That's exactly what I try to do. Is I try to go in and find out what happened. If you remember during the holidays, I believe it was between Christmas and New Year's, we had something very, very strange happen in the British pound where it dropped 200 pips and then opened 200 pips higher, and no one would give you any explanation. And now when you go to your charts, they've taken that out. You don't even see it. And that's total baloney, because there was actually trading going on there. I happened to be up that night watching it. I wasn't in the pound, but I was shocked, what was happening. So I don't know what went on there. I really don't know. So you have to be really skeptical when you see something that crazy. And we do get those occasionally, but, that's the first time I've seen something like that, since the 1987 crash. I mean, I don't know what it means, but you have to give it a little bit of respect, I think.
I hear you. Well, listen, Larry, it's always great to talk with you, and I wish I could listen to your show more often, but I haven't been able to as much as I would have liked, and I'm picking you up on the archives. But nonetheless, I'm glad to hear that your friend Dr. Miller is doing well. I'm glad to see that you are doing well also, and I just wanted to say to you what I've also said to Tom and Steve. If you recall, I've taken a couple of your live trading courses, and really, you've helped me out a tremendous amount, Larry. So I just wanted to say thanks.
Well, thank you very much. And, David, go to Salvatore Platterati's Deli and pick up something good for lunch today, okay?
Oh, no doubt. When are you going to get out of Arizona and come to Clearwater, Larry?
As soon as the weather, as soon as the weather gets too hot here. But right now we're in the midst of a winter storm here in Arizona, so it's going to be into the 20s this weekend, and that's really cold for us here. So as soon as it starts to, warm up, we'll be traveling back there.
Well, I don't want to tell you, but I'm going to go ahead and tell you that it's about 80 degrees and clear blue skies outside right now.
Excuse me?
I said I probably don't want to hear that it's 80 degrees and clear blue skies out here in Clearwater today.
Well, that's typical weather for you folks.
Yes, it is. Yes, it is. Well, listen, Larry, thank you for taking my call as always. Appreciate it, and we'll catch up with you sometime in the future.
Okay, thanks a lot, David, for calling in. Okay, folks, so the next thing we're going to talk about now is the overall market, because we have I'm going to put into Tiger TV the chart of the Russell Index, because we have this huge gap that occurred on the day after the New Year. And, folks, I mean, I know it looks really bullish and everything, and, we've taken out the highs from 2011 and highs from 2012. We've got a gap here, and gaps are very unusual, and all you have to do is go back and look at the IWM and go back as far as you like and try to find a gap that has not been filled, and you just don't find them very often. They're very, very rare. So gaps will be filled, especially a gap that's a breakaway gap like this, because it's really not, breaking away anywhere. It's just gone up there and hung there, and if something happens that this thing should gap down, it's going to leave a massive island out there. And if you remember what happened to Apple at 707 and 705 per share, we left a big island up there, and it dropped a great deal. And regarding Apple, I still think that we're heading, a great deal lower in Apple. My target is still $394. We need to get it per share. We need it to get it below 500, and that will trigger, the move to the downside. And it's looking more and more bearish all the time in Apple, because it just really doesn't want to, move up very much at all. And Apple is really a wonderful chart for trading if you like Fibonacci numbers and things. And we're at a moment of truth, as a matter of fact, in Apple right now. I wanted to bring this to your attention. I'm going to put it's just a 5-minute chart going back a couple of weeks, but it shows that how the market has made some of these nice little Gartley patterns. And what we've done now since December 27th in Apple, when we made the low at around that 505 level, is we had a big rally up to 554, and then we came down and made a 786 retracement of that rally at 515, and then we rallied up, and now we've made a bullish Gartley pattern at 518. And if we do not hold 518 in the Apple, in other words, we get below 516, Apple's going to be in some trouble. We'll finish up a little bit more on Apple when we come back. If you have any questions, 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. you take a hands-on approach to managing your investments. And whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. TFNN is proud to partner with Great Panther Silver for another exciting silver coin giveaway. The Great Panther Silver Super Silver Giveaway begins the week of January 28th and we'll be choosing 47 lucky winners. It's free to enter with absolutely no strings attached. Just visit the front page of TFNN.com today to fill out your entry form. Every hour that we're on the air, 9 a.m. to 6 p.m. the week of January 28th, we'll be randomly choosing one lucky winner that will win a silver coin or bar from Great Panther Silver and TFNN. And the final hour of the week, Friday, February 1st, we'll choose 3 lucky winners. That's 47 winners in just 1 week with over $1,000 in silver given away to our loyal listeners. Register today by visiting the front page of TFNN.com. And for more information on Great Panther Silver, you can click on their banner on the front page of TFNN.com or check them out on the NYSE Amex symbol GPL or on the Toronto Stock Exchange symbol GPR.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
927-6648. I posted the chart for Apple in there and showed you the 5-minute chart and how it made a few Gartley patterns and the importance of this 518 level that we have going in the Apple. If it gets below 518 today, that means it's breaking these 786 retracements that we've had since December 27th, and that is not a good sign. The next chart that I put into Tiger TV shows the long-term chart in Apple when we made the butterfly pattern, the ABCD expansion up there at the $700 per level. And it also shows that that's where the market went up there and held there for 5 days at a very high level. It had left 2 gaps. And then the next day, the market gapped down, and that left the island reversal. It is one of the more powerful signals in all of candlestick charting, because what happens is on an island reversal on the upside or island reversal on the downside, it means there's been a change in the continuity of thought. In other words, people that thought this thing was going to go up forever, all of a sudden decide, well, maybe everything's not right in Camelot, and they start to exit. Well, the market, dropped it dropped $200 a share, and so that's what's happening. Now, the important thing is if you believe in chart patterns, and I hope you do listening to Tiger TV, we have a situation going on in IWM, which is the small cap index. It's done the same thing. It's gapped way up here, and it looks really, really bullish, and it's just hanging there. and it's got a huge gap, and there's no gaps on this chart. So all I'm telling you is be really, really careful. Now, someone asked the question is, why is Apple acting so poorly? I have no idea. I don't know. They don't call and tell me. Steve Jobs and I were never very good friends. I mean, I shouldn't be sarcastic as someone as wonderful as he is. I didn't mean to mean that in a sarcastic, but I don't know anything about the fundamentals. I'm just telling you what's happened in the price action. So now all I'm going to do now is I'm going to put a chart into Tiger TV if you happen to be long IWM, because this is going to be real interesting. It shows the relationship between Apple and the small cap index, the IWM. And as you can see, the IWM has gone crazy to the upside, and Apple is making lower highs, all along. We could only make a 50% retracement off of the November highs on Apple, whereas IWM has made new highs on the year. So there's certainly something wrong with the price of Apple. Eventually, we'll find out what it is, but they're certainly not going to tell us now. But somebody certainly knows something about the price of Apple. Now, if Apple gets above that old high we made just last week at the roughly $5.60 per share, then I'll have to reevaluate. But right now, it looks like that Apple, it's a far, far weaker than market stock, which if you ever follow any of William O'Neill stuff, you certainly want to be buying the strongest and selling the weakest. And so that's telling you that it's under a great deal of pressure. Apple's been a tremendous stock over the years, but like everything else, the day in the sun, sometimes, happens to pass you by. And, long term, it could still be really good, but at $3.94 a share, it completes a big ABCD pattern, and that's where I would have, really strong interest in, taking a look, at the market in Apple at that particular time. Now, I believe that we've got this new moon coming up in a couple of days. That'll be on the 11th, and then on the 14th we have some really big astro things for the first couple of days of the 14th and 15th. And I'm not going to be on the air the 14th or the 16th, I believe. I got some family things that I have to do that have been planned for a while, and I won't be on the air then. But I will be on the air for Thursday. But next week I will not be on Monday and Wednesday. I should be on Thursday without any trouble, but Monday and Wednesday, not so much. Now, I wanted to put in, since we're talking about gaps, I wanted to put the gap on the New York Stock Exchange into Tiger TV and let you see that, because it's also gapped up, has the potential for also an island reversal. For an island reversal to occur, it has to be something pretty dramatic. I mean, it could be anything under the sun. It could be, problems in Europe. It could be an assassination. It could be a devaluation, a potential war. It could be anything that make it change, but that's what causes the continuity of thought to change that leaves these islands. And maybe it doesn't leave an island. Maybe it just keeps going and going and going to the upside. But with the New York Stock Exchange Index, you're dealing with some really strong ratios, just a very, very short distance from where we are right now. We're trading at, 86.38 and at 8,700, just 100 points away. You're looking at two major 1.27 expansions, so it's very important to keep an eye on this. Okay, we've got to take a break here.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and I think that we need to talk a little bit about the Treasury bond market. And so I'll put into Tiger TV the daily chart for the T-bonds going back well over a year. And we have completed, down at this 143 level, a big AB equals CD pattern that stems from, way back in September. And actually goes, September was the high, September was the low, and then November was the high, but it goes all the way back through July. So this is a 6-month pattern that's completing at this 143 level. And so this should be the last rally that we get. If we do get this rally, we're looking for it to possibly get up to this 148. I know it's only 3 points away. And with these markets as crazy as they are, you could make 3 points in a heartbeat in Treasury bonds. This is another reason why I don't think you want to get crazy bullish about stocks. I'm very bearish myself, mainly because of the fact that we've got an island up there in just about all of these things. That outlier event that we have in the New York Stock Exchange Index, and also the IWM, and even in the Dow Jones we have a big gap. So, but we don't have a gap in the NASDAQ. That has not even just barely made the 61% retracement. So that's another reason to be skeptical. But getting back to the bonds, the last time we made a bottom like this, in bonds. The bonds rallied just about 9 points off the B leg. Now, there certainly have potential to do that, but we are in the midst of the rally now in these bonds. I think we're going to rally a few more days, and then probably have a little pullback, and then one more move to the upside. So this is what I'm looking at in bonds. I'm incredibly bearish bonds longer term, and I'm even more bearish stocks because of one major thing. And I know you think that I like the patterns, of course, and I do look at the Bradley model, but I have an outlier event myself. It's a personal one, and I have to tell you the story behind it. When I was at Drexel, we had some wonderful clientele, and one of the gentlemen that I was fortunate enough to be his broker was a rabbi, and he was a really nice guy and just a really wonderful person, very well-to-do. He came from a tremendous amount of family money, and he lived a very good life, helped a whole lot of wonderful people, and followed the markets all the time. He hardly ever traded. But let me tell you the story behind him is that whenever he came in and said, boy, this is it. This is when you've got to get on to buy. And I'm going back 40 years I've known this guy. He has never been right, ever. And I talked to him yesterday. And he said, are you buying this breakout in the Dow Jones Industrial Average? And I said, Jerry, I didn't buy the last breakout in 1991. So, I'm just saying, be really careful, because when he comes on, it's really an outlier event. And I chuckled to myself, and after I spoke with him, which was fun. But he really is really a contrary indicator to these things, and he's incredibly bullish stocks now. But he doesn't trade. Remember that. This is just his opinion, and he voices it very vociferously. But he doesn't trade very much now. Someone has asked a question about the yen, because we're at a real critical level in the Japanese yen as we speak. We're making a 786 retracement here in the yen, and I'm assuming here that we've been watching this level in the yen for a long time, up at the 88.60 level, and I believe that we probably missed the high by about 20 pips. And what we have occurring now in the Japanese yen. And I'm going to do two charts into Tiger TV, because you really need to see the long-term daily pattern that goes back to last February. And we made that 1.618 expansion up at the 88.60 level. We got to 88.48. And today, what's happened is we are getting a retracement. The market is actually, I'm going to put it into Tiger TV so you can take a look at it, and you'll see that it's making a 786 retracement of that move. Now, this would be a low-risk entry point if you want to, be looking to short the Japanese yen. But it's trading at 87.94 right now. You need to get about 10 pips higher up to the 88.05 level, and then you would have a very low-risk selling opportunity. Your risk there would only be about 30 pips, which is $300. And when you're looking at a contract that's worth roughly $100,000, that is really not very much. So the risk reward on this is far better at this point than any other time. And not only that, but you don't have to worry about selling the high, because we were trying to do that at 88.60. This is just a retracement trade. So this is why we want to be watching this Japanese yen, quite closely right now, because we're right near the spot where we're ready to turn down. Now, someone asked the question of, what's the relationship between the Japanese yen and the stock market? And frankly, I look at these separately. I trade them separately. I look at them separately. If I start to think about what could be causing one thing over the other, that's when you get in trouble. You get an opinion of something, and that's what gets you in trouble. Your opinion will cause you more money than anything else. Paul Tudor Jones has a wonderful saying, and that is, lose your opinion instead of your money. And that's an important thing. And that's something I think you really, really need to keep reminding yourself when you look at these charts, is that it's just an opinion. Just like Rabbi Jerry, he has an opinion on something, and it's usually wrong, but it's still his opinion. That's that's all I can tell you. I can remember when gold was at, oh my gosh, how high was it? It got to 865 in January of 1980, January the 20th. We're coming up to the anniversary date. January 20th, 1980, gold hit 865 an ounce. It was up about $70, and he was in my office that day. And Drexel sold Cougarans and maple leafs to people. We didn't have all these fancy things now, but we sold Cougarans and maple leafs, which were Canadian. And I used to have those on my desk because we delivered them to the customers. They would buy 10 to 50, even 100 at a time. And there were a bunch of them sitting there, and he said, boy, these are really going to get more valuable now. And that was the high day in gold. I mean, there's a whole lot of other ones along the way, but be careful, because when he's really excited, we'll have to wait and see. Now, we do have, I want to mention the astrology part of this. On the 14th to the 14th, 15th, 16th of January, that's Monday, Tuesday, Wednesday, we have some really pretty big, powerful stuff occurring, but it's not as powerful as what happens on February 4th. That's the Bradley turn date, because the Bradley turn date on February 4th, if we're in a holding pattern or making new highs into February 4th, that means the Bradley has been inverted, and the market should get ready to turn to the downside. So February 4th is the key date. We have another key date coming in on Monday, Tuesday, Wednesday, but the real key date is 3 weeks later on February 4th. But we have the new moon coming in on the 11th. That should be enough for at least some type of a move in the stocks, because boy, since November the 14th, when we had the new moon and solar eclipse, these new moons and full moons have been within 1 day of a major turns all along. And if you remember, the last one we had was December the 28th. It was right after Christmas. The market sold off, if you recall, and then we were open on the 29th, and then and then the market it exploded, and then in the first few days of the year. Whether that's related to the January effect, I'm not sure, but the January effect usually refers to the first several weeks of January, that the stocks have a positive bias. In other words, the small stocks have a more positive bias than the large cap stocks during the first 2 weeks of January. This was work that was done by Yale Hirsch at the Stock Traders Almanac, and it does have some positive bias. That's usually only for the first few weeks. We'll have to wait and see if it's going to continue doing that or not. I'm not absolutely sure. Of course, no one else is either, and that's the real beauty of some of the things that we're actually watching. Now, someone asked me a question about the retracement that we've had so far today in the shorter term time frame over the last couple of days. What I'm going to do is I'm just going to put in the 30-minute chart of the E-mini S&P. I have to, I've got to, I'm just going to post it. I have to tell what it is, or people come into Tiger TV, they won't know what it is. If you give me a second here, I will type this in so we can see where we're at, that it's a 30-minute, and then everybody will be able to see it without understanding what it is. And it'll just show you that we made the 786 retracement up here at the 1459.50 level. We hit that exactly, and we're backing off 4 or 5 points. It's not very much less, but these others have doing the same thing. So we have this gap here, folks. This is the last time I'm going to say anything about this gap and all these things. The last time that I can think of today, anyway. But this gap is really important. I mean, this is. I'm a technician, folks, and this is not a bullish sign in the IWM or any of these others that left these gaps. If this was a good gap, folks, this puppy would be running like a striped deer through a forest. Let me tell you, this thing would really be going. In 1991, the Dow left a gap in January, right after the Desert Storm War that lasted six hours. That was a real gap. Every stock in the Dow Jones Industrial Market gapped up that day. 475 of the S&P stocks gapped up that day. And so this is the kind of gap that, makes things run away and hide. This is not that kind of gap. And this one went up here and has been laying in a, potato patch as far as I can see. So just be careful. because you don't want to be too long up in here with that gap. I mean, it might be really bullish longer term, but with this gap, you have to, sort of respect it and not, not get, not buying it. And the other thing is, Apple's been leading us the whole way through here, and I don't think that we have to, be concerned too much about Apple because it's certainly acting very, very bearish. And if we go below 518 today, this is going to be a very, very bearish sign on Apple. That means that everybody bought that stock, and when it was rallying up to 550, that 550 level is under big time underwater, and that's not a good sign, also. So we'll have to see it, wait till it gets to that bridge of 518. But if it does, then we'll be able to see it. Now the other question that someone asked me while we had the other break was about the dollar index, and we've had higher bottoms, since last August. When Tom became we're really bullish on this stuff down around the 73, 74, 75 level. We rallied up to a 3-drive pattern at 84. We backed off to a 50% retracement in the U.S. dollar index, and since we made our bottom in December, we rallied up to the 786 retracement. Now, if the dollar index is going to move higher, it needs to get above the 8100 level. We're trading at around 8064 right now. That would mean that the breakdown in the euro would have to get below the 129.50 level, which it could certainly easily do because it had so much resistance in that area of the 133 level. That was the ABCD on the daily chart in the euro. That I cover that in the newsletter every week because that's one of the major one of the major. I mean, that is, the euro versus the U.S. dollar is the major. I mean, more of that stuff goes on trading than 1,000 times of what happens in the stock market. So you want to, respect what happens in the euro because that's real money, looking for a real home. So that's a major thing to, take a look at. Now, I'd like to talk about the gold because we've had the gold and silver have had a little bit of a move off of our major bottom that we had in the gold at the 61% retracement down at that 16.28 per ounce level. And over the past several days, we've just completed an ABCD pattern on a shorter-term basis. I'm going to put it into Tiger TV because if you have an interest in buying gold, we just hit the level that it should hold from. The risk here, it's $160,000 contract, but your risk on this trade is only about $5 an ounce. In other words, it should hold the 1650 level because in the last couple of days, we've made the first ABC major correction over the last several days, and that's usually a buying opportunity, especially when you're in a minor bull market. But longer term, gold has some real potential because, we had all those higher bottoms that occurred, during the time frame of, June, July, August. We were, always talking about that because, Basil was too, so was Tom, so was Steve Rhodes. Everybody was watching that. Anyway, we've got to take a little break. We'll come back. We'll talk a little bit more about the gold and silver. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, we're going to wind the show up here in a few minutes. I want to talk a little bit about the trade of the year. I'm going to do my last trade of the year. I'm not going to do the trade of the year anymore after this year. I wasn't even going to do it this year, but I got so much requests to do it, I am going to do it. But it just, I get too many questions that I can't answer, and people just don't want to take the responsibility for these things. But we'll see. The trade of the year started way back in the 90s. The first trade of the year was to buy crude oil at $11 a barrel in January of 91, and there's been some other really monsters through here. But the last year we didn't make any money. That was to be short bonds. The year before, that one basically broke even because we were, I was bearish stocks. They went down quite a bit, but then came back up and took us out at break even. So we'll see whether this one works. There's two potential ones that I'm looking at, of course. One is the short bonds, and, of course, the other is the short stocks. I'm leaning towards the short stocks because of the gaps that are up here and the fact that these gaps are usually filled, and we're coming into this really big cycle date coming in on the 14th. It might even come in on the 11th with the new moon. I don't know. But, we'll see. But the 14th, 15th, and 16th of January are pretty big dates, but they're not as big as the February 4th date. That is a big date that you really want to watch. And, the market might break and then come back into February 4th, or it could go up into February 4th, or it could go sideways. We don't know what it's going to do, but when we come into February 4th, we'll have a pretty good idea where the market is, and that's what we want to be looking at. Remember, this is the person that told you that I thought we were going to start down really big on December the 3rd, even though we were down a few days after that. The market exploded into that full moon. I believe it was on the 10th, and, it just really took off, and off to the races and never looked back. So, this is longer-term stuff that I'm looking at with these trades. They last anywhere from 4 or 5 months to a whole year. So I don't know what I'm going to do yet. I'm still thinking about it. I'll have my next week. I will have the final vote out as whether it's going to be short bonds or short stock. And maybe I'll even do both. I'll make it because it's going to be the last one. I might just double it up, make one for bonds and one for stock. That's what Bill Foster thinks, is that we're looking at something major. I do believe 100% is that, these debts that we have out here, they're not going to be repaid. There's just too many debts out there, and the interest rates on some of these things, they're insane. If you're lending money to the government at 2.7%, who knows? Okay, the Japanese yen, the question is, we're up at this 88 level and change. We have to buy a 61% retracement or any retracement that we get. That's it, folks. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.